Good morning and welcome to the new era of agriculture commodity trade. Welcome to session 1, day 5 of Commodity Week World 2026 or CWW26. Let's do a visual and audio check. Neeraj, am I audible and visible?
Yes, sir, loud and clear.
Awesome. So over the last 4 days, this global marathon has mapped out the complex structural transformations across the global maize, wheat, rice, and oilseed corridors. Now, as day 5 begins, the focus turns to a sector that represents the absolute cornerstone of nutrition security, protein availability, and policy-driven trade dynamics across key destination hubs. Welcome to the Pulse's Asia Pacific War Room. The agriculture value chain has crossed a critical threshold. The traditional playbooks, the one that relied on the predictable crop cycles, stable freight corridors, and reliable trade alliances, have officially expired. Trade is no longer observing cyclical market corrections. Operations are running within a baseline of permanent structural volatility. CWW26, organized by HnyB Tech Incubations and Know Your Commodity, is presented by AgriGuru Online and supported by Kripco Agri, Bajrang Group International, and Mingani Group, along with our association partners OATA Myanmar, Ukraine Pulses and Soybean Association, and GOPKI Indonesia. Other institutional partners include Solidarad and World Cooperation Economic Forum. CWW26 is moving entirely beyond the delayed data of historical balance sheets and presentations. This is an unscripted, unfiltered war room. The mission is to democratize the high-stake market intelligence, mitigate the systemic risks of information asymmetry, and equip market participants with foresight needed to defend margins and ensure equity for producers and consumers alike. As a reminder, these sessions are beamed live across multiple digital assets on LinkedIn, YouTube, X or Twitter, Facebook, and our own event website. Let's take a macro view. While the grain provides human calories and oilseed power, the energy and fat sector, pulses are the critical anchor for global nutrition and protein security. Unlike highly globalized liquid oil or buckfeed grains, the international pulses market is an intricately tied, specialized trading network where a handful of key origins feed hyper-concentrated demand centers. The global pulses balance sheet is undergoing a profound structural realignment. We are close to 98 million metric tons of production, while the consumption has increased to 102 million metric tons. Shifting consumption trends toward plant-based proteins are expanding the baseline demand framework, yet the supply side is increasingly dictated by several environmental and macroeconomic constraints. The intersection of changing climate parameters, localized production shocks, and aggressive trade policy maneuvers has removed all margins for error in the procurement and trading of this commodity. To accurately evaluate where the physical market is heading, the focus must be placed squarely on the massive supply and demand currents colliding within the Asia-Pacific region. This brings this broadcast directly to our first panel of the day. Welcome to the APAC theater, where the production shortfalls and sowing crunches are making market volatile. Here in Asia-Pacific region, the pulses narrative is dominated by an insatiable domestic demand profile, changing cross intentions in major supply origins, and a challenging macroeconomic environment. Let's break down the critical APAC pressure points shaping the market today. Indian pulses requirement, as always, is always growing, and the domestic baseline is shifting. India remains the ultimate gravitational center for the global pulses trade. The domestic market is balancing structural supply dynamics against intense environmental and policy pressures. A weak Indian rupee trading between 95 to 97 against US dollar act as an artificial price floor for all imported pulses, heavily amplifying the landed cost and freight cost. Compounding this macroeconomic squeeze is an intensifying super El Nino, which alongside low residual Rabi soil moisture threatens upcoming Kharif sowing, and even the intention of Rabi could be challenged. On the policy front, government aggressive 5 to 8% hike in minimum support price set a high economic floor. In the specific crop segment, a complex dynamics is unfolding. For pigeon pea or tuar, the market faces a firm outlook as poor rainfall stokes crop failure fears, balanced against a governmental buffer stock of close to 1 million metric ton. For black mape or urad, the market exhibits strong breakout potential due to immediate crop jeopardy and a complete lack of government buffer stock, which is a safety net for majority of other crops. Meanwhile, the desi chickpea or chana market is transitioning into a firm bullish phase. Flat production during the past Rabi harvest has left domestic pipeline thin, while anticipation of lower Rabi crop in upcoming season can boil things, and the government holds hardly sufficient buffer stock of 8% of the demand to intervene decisively. Let's go to Australia, where the sowing reduction of the chana could be a challenge. As India's internal chana pipeline dry up, the international market traditionally look at Australia to fill the structural deficit. However, the latest data from Australia indicates a critical supply shock because of the high input prices as well as upcoming weather challenges. This is altering the intention of the farmer for sowing. Anticipation of this reduction in output, Australian origin exporter might hold out for higher prices when this supply crunch is combined with the weak rupee, making these imports highly expensive. Regional processors and buyers face an immediate margin squeeze, forcing a sharp reliance on local stock bidding. Now, the third important actor in this geography is Myanmar. We have seen that of late, the black mape and pigeon pea export, starting from January all the way till end of the May, there has been a serious shortages in the export of these two commodities from Myanmar to India. In some cases, we have observed close to 27% reduction when we compare it to the last year. This might signal that there is a possibility of shorter than anticipated crop from the last year. And the upcoming weather challenge also could restrict Myanmar's net export because El Nino will impact Myanmar as much as India as well. For the commodities like urad, which carry a strong structural import dependency on Myanmar, these reduced export flow coupled with the highly inflated landed cost driven by currency depreciation leave regional trade players completely exposed to volatility, supply short environment. However, we have seen that Brazil can play an important role here because Brazil is anticipated to produce close to 300,000 metric tons of urad or black mape. Now, opening this war room the day of relying on lagging monthly reports to make multi-million-dollar procurement decisions are over. Navigating this extremely volatile, this extreme volatility requires elite ground-level foresight. Over the next couple of hours, this session will extract that foresight. An elite strike force of EPEC Pulses experts have been assembled. The panel features the physical merchant managing cross-border flows from Yangon to Adelaide, the macro analysts modeling the shifting crop parameters, and the commercial leaders executing large-scale procurement amidst the supply crunch. The mandate for the session is simple: no script, no filters, pure intelligence. To live audience, engage with the data and prepare to rethink coverage strategies. The market does not wait, and neither should the industry. It is time to secure a strategic edge. Welcome to day 5 of Commodity Week World 2026. Let's officially open the Pulses Asia and Pacific War Room. With that, I would like to invite my first speaker, Simon Dax. Hi, Simon, are you here?
Hello, can you hear me?
Yes, Simon, I can hear you. Good to see you. Good morning.
Good morning, Deepak.
So Simon is an accomplished international merchant serving as a senior commodity trader for Pulses at the Louis Dreyfus Company, LDC, a global leader in agribusiness. She leads the commercial strategy for Australia's lentil and chickpea portfolio, overseeing origination, accumulation, pricing, and risk management across domestic and export market. Simon brings a practical frontline perspective on how Australian production integrates into global Pulses supply chain. So Simon, my first question to you, how are you seeing the upcoming Australian Pulses crop and what signals are you monitoring around origination, grower engagement, and sowing intentions?
That's a good question, Deepak. I guess at the moment we're seeing the tale of basically north versus south. So if we start in the south of Australia, in Victoria and South Australia, we've had a really good start to the season. So this is where most of the lentil production is situated. The growers had really good pre-sowing rains and basically planted everything that they were anticipating to put in. And since then, we've had some really good rainfall. So, you know, the information from on the ground is that growers are feeling really optimistic about the start to the season that they've had. And we expect that the lentil plantings will be in line with what went in last year, if not maybe a fraction more. But yeah, we a really big green tick to the start of the growing season for lentils. If we move to the north, so Queensland and northern New South Wales, which is the higher concentration of where the chickpeas are grown, a bit of a different story. So if we look at northern New South Wales, they really struggled, or they really had no pre-sowing rain, and the soil moisture levels were almost as low as they were in history. So, you know, things were looking pretty grim, and the growers were certainly not feeling confident that anything was going to get into the ground. But last week we did have some really timely rainfall in those areas. So I think the sentiment has changed somewhat. The growers have moved from thinking, you know, we'll leave these paddocks to fallow, to now sort of thinking, yep, we'll throw the dice and put something in the ground. of course, we'd like to see more rain, and potentially we've probably got until the 20th of June before the window's really closed completely. So we do expect that a lot more chickpeas than we had originally thought will go in. The exception's probably to the west of New South Wales, where they didn't get enough, and there's basically no growers that are going to put in chickpeas. So I guess overall, we'll certainly see the chickpea area down year on year, but the consensus in terms of what the crop might look like is pretty wide, anywhere from 1.2 million tonnes to 1.6 million tonnes after last week's rain. So still a fair bit to play out there, but certainly is looking more positive than it was this time 4 weeks ago. In terms of the growers' behaviour, the grower's been pretty sticky this year. So we did have some, record lentil and chickpea crops, and it did feel like that we should have been able to hit exports pretty hard, but the grower probably took the market by surprise, and was fairly sticky on letting anything go. And really, that's probably just a reaction to the fact that they already had plenty of cash in the bank, and secondly, they're probably less impressed with the price than they were the year before. So I guess that's one thing that we need to be mindful of at the origination, even if the supply is quite good. The key is in the grower's hands. So if they don't sell, it makes it very difficult for the product to move out to the export pathways and make its way to India.
Awesome. Simon, actually, I would also like to understand, do you see any carry available from the past crop with Australian farmers by any chance, both for chickpeas as well as lentil? Is there some carryover left?
Yeah, certainly. And I think that just plays into, as I said, the fact that the grower had been holding on so tight to the product. We're seeing more carry out than what we probably would have anticipated. So certainly there's still at least 500,000 tonnes of chickpeas, old crop chickpeas, to find their way out of the country, and probably something similar of lentils, mostly concentrated to Victoria.
Fair enough. And what are the key drivers of, while I've talked I would say in brief about the weather and the input cost, but according to you, what are the other key drivers which are anticipating reduced planting of chickpeas, while lentils is not that bad?
Really, it's really about, I guess the growers rely on three things. So it's the price that they get for their product, it's the rotations that they're getting their agronomic advice on, and then lastly, it's the rainfall. So when we look at the lentils versus chickpeas, I mean, price, they're not in love with it, but it's still making the money. So at a gross margin level, it makes a little bit of sense. But the rainfall was the big issue for the chickpea area. And as you touched on, the fact that input costs are much higher, growers less likely to take a risk of planting it and just wishing for rain. They want to see that, okay, if I put it in the ground, there's every chance that it's going to grow and produce something.
And how is the outlook for wheat impacting in any way, the pulses crop? Do you think because there is a reduction in the wheat crop, there could be a possibility a small switch by farmers to pulses? That's a possibility, because even that number doesn't look that great from Australia as of now.
Yeah, you're right. So I guess the fact that the later we get into the season, the less likely the grower is to put in wheat. It's certainly not, it doesn't do as well later in the season. But what we are seeing and hearing on the ground is the growers more likely to put in barley. So barley, they can feed domestically, they can sell it domestically. It goes to exports as well. So, the price for barley should always have a stable floor, and it grows quite well. It's fairly resilient, just as chickpeas. So yeah, you're right. Wheat is probably out, but what goes in is more likely barley, and then, to a lesser extent, chickpeas.
Excellent. Now, I would also like to understand another aspect of Australian trade, which is actually the port congestions. Do you see with the, I would say, the challenges in the logistic all across the globe, high prices of logistic, insurance, as well as availability of the containers and the bulk ship? Do you see even the logistical challenge can also be seen when trying to move from the material from farm gate all the way to the export destinations?
Yeah, I think there's certainly, I mean, there's always going to be some element of logistical constraint. I think in Australia, it's probably more the roadside logistics. We're quite a big country. Most of the agricultural product is grown more than 400 kilometres from the port, and it's structurally expensive to get the crop to the export pathway. The East Coast doesn't have a great rail facility. So that's probably where we see more of the bottlenecks is on the land side, trying to get it out to the export pathway. For the vessel logistics, I mean, yeah, there is often some delays in vessels coming in, but for the most part, just given there's so many options of ports and things like that, that's generally not where we see the delays. It's more trying to accumulate the grain to get to the export pathway.
And Simon, how do you seeing that different export markets working out from Australia? Do you see, because the prices in India, they have not been for parity for a pretty long time, but still some exports or import in India and export from Australia are happening for chickpeas. Do you see that in India playing a more important role going forward? Because Middle East, which is also, and Mediterranean, which is also one of the big destination for Australia, looks a little bit choked as of now.
Yeah, I think, I mean, there is a disparity between pricing at the moment. It doesn't make a lot of sense to pull chickpeas out of Australia and ship them to India. There's not really a financial incentive for companies to do that at the moment. As you said, it is still happening in some capacity, but certainly we probably need to see a realignment of those values to see any substantial volume make its way there. But yeah, outside of that, I guess, India is quite a large player in the chickpea market, and the Australian grower is really reliant on that Indian market. So I guess that's where we're trying to, as the growers, I guess that's their first preference is to try and land it there. But yeah, price will be the main driver. And if they don't get what they want at the farm gate, then they will just sit on it and it won't make its way out.
Perfect. And how do you see going forward? Another, I would say, the challenge of risk mitigation, right? You're handling a desk which is right, left, center, right? Is having a currency fluctuation, logistics challenges, parities issue. As a trader, how do you ensure that actually, you minimize your risk? Maybe sometime you might not be too worried about the profits or the margins currently, but how to minimize the risk? What according to you are the steps which are critical for any trader to ensure that we minimize the risk?
I think for us, we've got boots on the ground in all countries and in country as well. So basically getting accurate, timely information reduces our risk substantially. And then second to that is, we're quite diversified. So not only on the pulse desk are we diversified in our origins and destinations, but as a company, if it doesn't look like there is going to be a big year in pulses, and we've also got oil seeds, we've got grains, a whole basket of other commodities. So I think diversification is probably one of the biggest levers that we can use in our risk mitigation. And of course, in trading, there's always going to be risk. We can't get rid of that fact, but we obviously do everything we can to make sure that from our perspective, most of our risk is mitigated.
Awesome. Simon, thanks a lot for sharing your views and wishing you all the best. I think we are having an exciting 1 year or maybe 2 year when it comes to pulses, because I think El Nino and the war is not going to have just short-term impact. Could be a little bit more between 18 to 24 months. Thanks a lot, Simon, for joining, and it was a pleasure to hear your views.
Thank you. Thank you for having me, Deepak.
So now let's stay within Australia, and we are having our next speaker, Mr. Jay Shroff. He's an expert pulses and grain merchant, currently serving as director at Mandala Trading. He specializes in global commodity activities as well as cross-border trades. Operating heavily across the APAC region, he specializes in the international sourcing, risk management, and distribution of peas, lentils, and chickpeas. His core competency centers on navigating the volatile regulatory environments, import quotas, and tariff structures of major destination markets like India and Bangladesh and Middle East to ensure seamless trade continuity. Welcome, Jay Bhai. It's a pleasure to have you, sir.
Absolutely great to be here, Deepak Bhai. Can you hear me well?
Yes, loud and clear. And,
Okay,
you're looking dapper with your awesome background.
I'm in actually a MSc head office. So it's a really great building here. It's a very nice building that they have bought. It's a pretty good place in Australia, so it's nice. Yep.
Awesome. So, Jay, let me delve straight away into my first question, and very important question, and very short as well. How is Australian pulses production looking like this year for you?
It's been a roller coaster. Obviously, everybody's aware of it. We've been talking about El Nino impacts. We've been talking about different kind of input cost that is related to the war perspective. But I think this year we're gonna have a decent crop. It's not gonna be substantially poor. I think the last couple of weeks we've had a good rain in the region, in the northern region, where most of the chickpeas are grown. So before we were looking at a crop that would be devastated, but this time we're looking at least we'll have a crop that we will be able to export. So it's not going to be as big as last year, but it's not going to be it's going to be definitely above the average that we generally grow. So this year, from that point of view, chickpeas is looking all right. Lentils, we predominantly had a record crop last year, and I see at this point of time the favorable conditions is looking pretty good. From lentils point of view, as of today, it would be predominantly, if not the same as last year, it could even be higher than last year as well. So we're looking at it as a good crop for lentils this year. So overall, pulses in Australia, as we would have anticipated it to be a little bit difficult from the input cost, where we are not having a lot of urea issues and all the other issues. We probably had a very good crop, but because of this world situation and dynamics, the urea constraints and the fertilizer constraints and biodiesel making a big jump there, and the diesel fuel cost increasing is going to be a little bit of a variability this year. So it's going to be a very interesting year for pulses.
Excellent. No, very well said. Actually, that makes us a little bit more optimistic, because a lot of people were writing literally Australia as one of the bad actors this year, not growing sufficient pulses and wheat. No, we also seen that because you understand India a little bit better than many of those who export to India. I would also like to understand what is your anticipation of the policy regime in India? How do you see from Australia the Indian policy unfolding going forward?
Well, look, I think India is it's a very important country, and they are going to be looking at sufficing to what their needs are going to be always. Their policy is going to be to cater to their population and their citizens and their farmers as much as possible. If you look at from the products that we are exporting from Australia, it's a very small parcel, and it's only filling the gaps that India is not able to produce to suffice for the rest of the year. Policy-wise, we have no other option but to adhere to see how India plays its political as well as its farmer management and in the crop that they are growing. I think this year it's a very big challenge for the nation and for all the ministers to see how they can manage the inflation cost with the price, as well as with the importing, as well as the El Nino impact. Everybody is using the word El Nino massively, but I'm not sure how much of an El Nino is going to impact this year versus the entire war situation that is also creating a big disruption. So policy point of view, I would say that India's policy is something that we are always constantly looking. It's easy to say that we would like to get heads up as in what they're really looking to do that, but that's something that's never going to happen. So we just work around the policy situation as much as possible and work around there. We do anticipate a lot of times as in what we think the policy is going to be, how the duty is going to structure up or come down, given the MSP criteria, that we do follow what the MSP criteria are, where the rainfalls are, how the harvest is happening, what the crops are, who's got how much stock how much the government is holding. All of that does make a decision, a fair bit of understanding where the policy is heading. But still, obviously, we can still get blinded. But with all that information, it's like a calculated risk versus uncalculated risk.
Now, let me unblind you a little bit, Jaypai, based on actually what we are seeing on the ground. And this is for the audience who are logging in from outside of India. This year, the government mindset, again, sometime I speak with the language which looks very authoritative, that actually if I would be having the direct call from the Prime Minister or the number two, the Ministry of Cooperation, right, telling me the data. But this is actually more of an analysis, because you engage with different stakeholders in the government and then you try to study. Right. So this is not something which is a government's official statement, but this is what we read between the lines. First thing, in such scenario, government is very keen to ensure as much as stock available on Indian shores. Right.
Yes.
That's a point number one. Affordability is secondary, availability is primary for the government to start with. So any policy decision would be around ensuring availability, because we are in a long game and nobody knows what El Nino can do. Right. There are historical evidences where actually it can reduce crop like anything. And then sometime, if you are lucky, right, that geospatial or the timeline spread is such that your crop is actually is able to be resilient to that. Second, government sees that possibility there could be better encouragement to grow pulses in India this year. For simple reason is that people would try to shift to hardy crops, which happens to be, for example, soybean or tuar, pigeon pea, while urad is a short-term crop, so that is all based on the God's will, right? At the same time, the chana, the desi chickpea, is the largest pulses. It is close to 40 to 50% of our whole production, and it controls price of all other possible commodities. So government would be very keen to ensure that the Rabi sowing increase. So you'll be having increase in MSP, maybe higher than the MSP increase of the Kharif season we have seen. And this makes, I think the price of chickpea not a big worry for the government. But at the same time, as I initial remark itself, I've said, government is holding close to 8% of our demand, right, as buffers. But will it use the nuclear weapon on the day one? That's $1 million question. Until unless prices are actually growing steadily, government is not having a problem. But if you see, we have seen in the past, the speculation comes in the game and suddenly you have 10, 15, 20% rise in the pulses prices. Government is not going to tolerate that. They'll intervene only and only then. I don't see government changing too many things, provided the trade plays with a straight bat. That brings me, please, Jabba, you were saying something?
I was just going to say that also, given that we don't have such a large crop coming in Australia, and we don't even have a lot of chana that has been holding back. So there is not enough availability of crop till the new season, and the government already having to be able to import or has almost 10% of the stock already there. I do agree that if the prices shoot up by 20%, the government is going to intervene. But till then, there is an opportunity for the trade to just play. And not to play sport.
Yeah, I think there is a good possibility. Trade is fair, government is fair, and the consumer and farmers also get benefit. I think maybe the turmoil, but actually it will fix pulses trade in India for long. This will redefine how the trade is done in India for sure. Now, according to you, what are the specific parameters which dictate your pricing strategy when hedging shipments across volatile OPEC trade lines, and also your views on how the Pakistan and the Bangladesh will play?
Bangladesh is a major market. Pakistan has been coming in and out. So Pakistan market has not been a very big spoil sport. They come in, they buy, they make it a big hoo-ha, and then again, suddenly they are lost, they're gone. But whereas Bangladesh is a market that keeps coming in. So we do cater to Bangladesh as a main market point of view, as payment terms are also very important. One of the risk management strategy is to try and see if we can push ourselves to do a lot more cargo or a lot more trades where there is a payment security, where there is LC component added to that, right? And that defines a lot of our strategy towards how we are trading into the market. Bangladesh has been very consistently buying and has been the market where it's pretty understandable that they are using it for as a staple product during the time when there is during Ramadan and everything. So they'll probably try and procure some which they haven't been able to do in the past. So that ways, if you see, that has been one thing that has kept the market steady, and they have been the ones who are keeping the price up there as well. Pakistan every now and then will need small volumes. They'll buy and then they will stay back and stay put. They get a lot of cargo coming in from Russia, Ukraine. That is their Kabuli chickpeas, which also kind of offsets the need for the chickpeas, which makes it a bit a difficult situation for us to analyze. And also understanding that the transit period from Australia all the way to Karachi is a bit higher and longer compared to what is with Chittagong. And Chittagong is the trade from Australia to Chittagong is a lot more value proposition for the shipping lines for as well. So to get more availability and facility there, that becomes a much more liquidity market is a bit more there. So yeah. Was another question that I missed?
No, not at all. Not at all. I think, like, as you rightly mentioned, the Bangladesh, and also just before I let you go, just a small intervention of how do you see, like, the market of Mediterranean and Middle East, because nothing is moving there. So are you able to move something and by making a phone call to Iran or Mr. Trump?
I did try, but somehow, my line got disconnected. Somehow I did not get to the right person, but nothing is moving there, and it's too risky for anybody to move there. It is, the gutsy guys can find a way, and they have to find a way. They'll probably find a backdoor entry. They'll probably go through Oman. They'll probably go to Koh Phangan, the other ports, but nothing is going there. We've got almost about 50 or 60 boxes that is still sitting at the Strait of Hormuz on a vessel to be coming to India for last 3 months. So there is the shipping lines are also charging supremely high. They've got the $2,000 extra cost to just take the container there, which is predominantly trying to discourage anybody taking any cargo there. So I think there will be a lot more cargo that will be moving into that side more from land based. So it might go to Jeddah, and then from Jeddah it'll go in, but it'll not be containerized. It'll be a lot more vessel oriented cargoes who will be I do think there will be a lot of cargo that might even get exported from India to that side, because they might need a short-term gap to try and fill the requirement, immediate need, and that's easier to do it from India than coming all the way from Australia or from Canada. That will take a lot longer. So India or anywhere near neighboring countries will be much more efficient for them to take the cargo straight in a short duration. And so, let's say if there was a ceasefire for 15, 20 days, it'd be a lot easier for a cargo from neighboring countries to move in straight away rather than coming all the way and taking that higher risk. So a lot of land movement is happening. Sea freight's reduced and not really that heavily at this point of time.
Perfect.
I don't even see this happening and settling down for the next 6 months. As you said, I don't see this as settling down for the next 6 months as well.
Perfect. No, I totally understand, and that's where the traders become sometime anxious of, like, in every morning we get up and see what is there on the Twitter or the Truth Social, rather than actually checking out what are the market prices. So that's unfortunate reality, but it's what we live in. Thanks a lot, Jaybai. It is always a pleasure and honor to have you as a speaker and a panelist with your views and insight, specifically, like, on chickpeas and lentils, as well as with the context of Australian global trade. Thank you, Jaybai. It's a pleasure to have you, sir.
Thank you. Thank you, Deepak. Thank you, sir. Thank you. Cheers. Bye.
So now we go to our next speaker, again, a very eminent personality and a very close friend from Myanmar. So Mr. Sham Nurseria, he's an industry leader and CEO at RV International Pte Limited, boasting of close to 25 years of continuous trade execution experience based in Myanmar. Qualified chartered accountant and engineer, he brings a highly analytical, tech-driven edge to Global Pulse's origination. He's a prominent featured speaker at Global Pulse's event and is office bearer at Overseas Agro Traders Association. And he has been kind enough to grant us the partnership, where you can see behind me the logo of OATA, which has been doing phenomenally great work in ensuring that overseas traders from Myanmar are having good time. He is recognized internationally for his deep command of Southeast Asian crop cycles and flawless business reputation. Welcome, Shamba. It's a pleasure to have you, sir, again.
Good morning.
Good morning, sir. Good morning. So, sir, first question, how do you shape your approach to evaluating the trade signal and processing margins in Myanmar's pulses market, and your views on the pulses production in Myanmar, sir? Over to you.
I'm sorry, there was some internet problem. Can you repeat your question one again?
Yes, sir. Actually, I lost my earphone. Just give me a second. Yeah. So what I was saying is that, sir, actually, how do the production condition looks like in Myanmar? We have seen, sir, that there is a little bit of dip in the exports coming to India of both black mape and pigeon pea since January. So is it because of that anticipation of the previous crop was a little bit more optimistic? And how do you see the impact of El Nino going forward in Myanmar, sir? This was the question, sir.
Yes, yes. See, the production numbers in Myanmar is normal. There is no big changes. Means rather, I would say, if you compare to the last year, this year is also similar and slightly better. But there are rumors or there are people spreading that Myanmar is short. It is not short. Black Maple, the main production is around about 8.5 to 9 lakh metric ton, and pigeon peas is somewhere around 3 lakh 30 to 3 lakh 50,000 ton, which is normal. Now, coming to the exports for past 5 months, like from January to May, we have data. The black monthly exports have been 3 lakh, but the average exports from Myanmar for the month is around 75,000. So far in 5 months, the export is only 3 lakh metric ton. So almost 20% short, which is not a matter of big concern seeing the world situation. But my worry is in pigeon peas because the pigeon peas export is a little over 100,000 tons, 1 lakh tons. And the average export from Myanmar for pigeon peas is somewhere around 30,000 tons. So for 5 months, it should be 150,000 tons. So almost 50% less exports is a matter of concern. Yes, not only because of the Iran situation, but also because there are so many uncertainties. Means there are so many variables now. Not only the pulses market, but also the exchange rate, and that I don't know what happened to the buyers last 4 5 months. Means they are going over cautious, or they're not making stock, or they're just going hand to mouth. There are so many factors. Now seeing what future regarding, as you mentioned, means there have been so many talks regarding El Nino. It is a big concern, and even the government is taking all the steps to maintain the buffer stock. They have been doing buffer, but I don't think that pigeon peas and black mapte they have enough stock. They mainly focused in chana, which our other experts will say. But for yes, pigeon peas and black mapte, going forward for next 15 days or 20 days, I see the market may improve because the prices are almost low in the lowest levels. So El Nino may affect, but as we know that more effect will come in August and September. So for Black Mapte, I don't think much effect will come because Black Mapte sowing and harvesting is done by end of August. So and Black Mapte even don't need much rainfall. It's even 1 or 2 shower at the time of sowing, and at the time of flowering, the 1 or 2 shower is enough. So, but we have to see the spread of the rainfall, how it is spread throughout the country and especially in the Black Mapte region. But for pigeon peas, yes, it is a big concern because actually pigeon peas need water, say in September or October to get a good yield, and that is a matter of big concern. So my take from here is that pigeon peas, we have to wait and see, and it may really surprise Indian consumers. That's what I feel. But black market is also a matter of concern, and it may affect, but we have to see the spread of the red.
Sir, how is Moong doing? Is China buying more than actually it generally used to buy? Because I think those numbers look pretty interesting as well.
No, no, no. China this time is not at all buying in the numbers, but as I mentioned earlier, also even in China and even in the last meeting also we had that there is a problem of pesticides which the Myanmar authorities and government is trying to tackle, but so far they have not been successful. And China has almost returned more than 2,000 containers of loaded and arrived mung beans from China, which was diverted to Vietnam last year. And this year also they are very cautious, and the numbers have been to China from Myanmar has reduced to almost 25%. So at the beginning of the season, around February, the moong price went up too much. It went around 1,200, 1,300 FOB levels. But now it has come down again to below 1,000 levels. So China is not buying. It's a matter of concern for Myanmar side. But let's see if it is solved. And actually, we talked to the agriculture minister in Myanmar, and they were very serious, and they are trying to ban those chemicals, which is a concern for China. So they are working on it, but it's not done on the immediate basis. It might take 1 or 2 seasons to get rid of this pesticide issue.
Perfect. Sir, actually, predicting Southeast Asian crops has been a pretty difficult job, right? And you have been doing it very successfully, right? Your numbers I always see as a gold standard. And if you could recall, this is, I think, fourth session we are having. And every time the numbers you have shared, end of the year, when we look at the supply and demand, and it comes perfectly accurate, right? I would say I've not seen someone able to predict Myanmar so well. Even actually, I had on ground visits to understand it, but even I was not able to get that level of accuracy. But you have so accurate. So how you are able to accurately gauge the market? What is the secret sauce, sir?
The first secret is experience, which is no more a secret. Means almost 25 years here and working at the ground level. I have around 19 people with me, a team of 19 people who look after the quality, from whom I gather all the information, not only from the farmers, not only from the fields, from the Yangon warehouses and the trends. There are so many factors, especially first-hand information is the sowing, and then after sowing, what is the rainfall and how much fertilizers they are using, how much like urea and all they are using, and how is the flowering and how is the acreage, it is going up or coming down, and then arrival pattern, that how many cars arriving during the harvest time, how many cars are arriving, and then all the warehouses even in the countryside and even in Yangon. From that, I make one assessment, which is purely based on my experience. And then I come out, yes, I appreciate your view that my numbers are almost 97, 98% correct. Even the local association in Myanmar, which is the head main association of bean and pulses, they also now last 3, 4 years they are taking my figure. Even they ask me, please advise what is the volume. So it is a compliment for me from even from them. So yes, that's the secret.
And Shambhai, one more thing, when we talk about India-Myanmar trade, right? The challenge is that reputation. And of late, Myanmar used to have a very good reputation, but of late we have seen the default happening from the both the sides, right? That has become last 2 seasons one of a challenge. Do you see going forward this to continue, or there are always already, because you have involved with multiple association as well as the governments, the policymakers on the both side of the border? Do you see that this thing is going to improve this season, or do you think no, not much can be done about it? Because getting a spotless reputation is very critical for this sector, which I feel is somehow right now not on the track.
Deepak ji, very good question. Uh, Before I answer to this, I must say that I was in delegation with the Myanmar president to New Delhi and Mumbai last week. I just returned yesterday. So, yes, India and Myanmar now share a very good relation, and all the credit goes to the Indian embassy in Yangon. And also a good counter response from the Indian side, Ministry of External Affairs. The last 5, 6 years, India has really developed and made and maintains a very good relation with Myanmar. And regarding the default, it was a very serious issue earlier, but as we know, in Myanmar now, there are handful of suppliers because of so many reasons. Because the import is restricted here, and only the 3 or 4 importers they are able to export. So from Myanmar side, there is no default, I can say. Absolutely no default. If you buy from any like Tom, Dick, and Harry, and then pay the money in advance, there might come a problem, but not even in percentage. So from Myanmar side, even the people are good. Myanmar people are very honest. They always value their words, means their commitment, even in India. But this default happens if there is a speculation, over speculation, and I don't see speculation since last 1 or 2, heavy speculation since last 1 and 2 years, because speculation or whatever price movement is a part of trade. We cannot ignore this. If this happens, 5-10% is normal, but not in day-to-day basis. Say 2 or 3 months, 5-10% is normal. But it that did happen in the past that few people want to control the market. They raise the market 15-20%, and in some cases the Myanmar side is short or the Indian side some buyer is short. Then default happen. But last few years there is no default, and we are happy that even the Indian side also they are maintaining the good contract commitment, and even Myanmar side. So default is no more an issue for our trade nowadays for last 2-3 years at least.
And sir, last question before I let you go, sir. How is this INR KR trade possibility going forward, sir? Can we remove the dollar from between the trade? Is that moving? Because that is also being getting cooked just like a khichdi, taking a little bit longer than we anticipated.
See, again, a very good question. The entire trip of the Myanmar president, he was pushing, he met the RBI governor, even the Central Bank of Myanmar governor was also with him, finance minister was there. They discussed a lot about rupee trade mechanism, and I too wish it should go successful, but there are so many limitations, especially with respect of payments in Yangon, like the exporter, they don't want Indian rupee. If they get Indian rupee, what they will do? The only thing is, like India exports to Myanmar around $600 million of pharmaceuticals, and Myanmar exports to India around $1.5 billion of pulses and few other minerals. So I feel there is a big gap, but still at least we can do this 600 million or say 500 to 300 million. It will be a big success. The pressure on Myanmar also for US dollar will ease, and even for India, 1 billion or 500 million is a big amount, at least some relief. But problem is Myanmar side, the exporters face problem. They cannot sell the dollar rupees which is received in the account. If they get license for the import, it will be easier. Ministers and they say they cannot prioritize the license for Indian rupees at the moment. So that is going to be an issue. Exchange rate is also forced that literally transfer from chat to dollar, dollar to rupee, and then rupee to dollar and dollar to rupee again. That is bit confusing. Plus, the bank charges are very high, and not many banks, only Punjab National Bank have been given the role to do this trade. That is also a limitation because in India, I might have so many other banks, not exactly Punjab National Bank. I may route it, but the charges will be high. And as you know, in our trade, the margin for the pulses trading, the margin is negligible. Means not even people are working, not even in 0.5%. And okay, this will maybe it's a temporary stage, but if you are earning 0.5%, how can you pay the expenses of 1.5%? So I hope it works. It will take time, and both either government is very serious on it, and they may resolve it. But for the timing, looks difficult. But we are very hopeful.
Thanks a lot, Shamba. It's always pleasure to have you on our sessions, and it's pleasure to have insightful understanding about Myanmar trade from you. Thank you, sir.
Thank you.
So now we move to our next speaker. So we are having Mr. Sunil Patwari. He's an eminent international trader serving as the Managing Director of Seasons Overseas Pte Limited in Singapore. With over 27 years of experience featuring top executive tenures at ETG and Adani Wilmar, he commands high-volume commodity books spanning 5 continents. Specialized expertise focuses on African and Southeast Asian trade dynamics, corporate risk mitigation, and execution of large-scale cross-border agri-trade operations. Pleasure to have you, Sunil Bhai. It's great to have you on the session, sir.
Yeah, good afternoon, everybody. Good afternoon, Deepak. Thank you for having us.
So, sir, straight away the first question, drawing on your extensive executive experience spanning 5 continents, how do you evaluate the current structural shift in the global pulses trade dynamics, sir, with all the crises, the weather, as well as currency playing a big role?
Yeah, so for pulses trade, every year is a new year with new challenges and new dynamics. So this year, everybody is talking about El Nino, but we have to wait and see how things goes, how things shapes up. But hopefully things might get better. Initially started a bit warm, but I've been hearing some rain in India, so hopefully things will get better, which are good for the crop. Like recently, we have seen price changes in oil seeds and other commodities also because things are getting better for rain. Earlier, if you see the main dominancy for the pulses trade was out of countries like Canada, Australia, US, and other countries, but that is also shifting in a big way. If you see Africa crop for pigeon peas, it has been growing every year. Russia for yellow peas, Russia, Ukraine, all these for yellow peas and lentils also growing there. And even South America, Brazil. Brazil is coming up in a big way in terms of black mape. They are ready for pigeon peas if they get FITO approval from Indian government. They'll start even exporting pigeon peas. So there is a big shift in terms of dynamics of countries from a very, very developed country to upcoming countries like Africa, Russia, Ukraine, and South America. So that is again a big shift which has been seen in the pulses community that can make a lot of changes, and it can give a real challenge to countries like Myanmar, where black mape we are totally depending on Myanmar, and now with Brazil crop coming up, the price are more stable, people have more option to trade, and there are commodities which are even better than sometimes the commodity coming out of Myanmar, the quality coming out of Myanmar. One quality, one consistent quality. Next, we are talking about India as terms of Atmanirbhar. Indian government is really very serious about this in growing pulses as a commodity, supporting farmers in terms of MSP every way. So this can be a big shift. So again, the big concern, I've been a pulses trader over 30 years. If India become Atmanirbhar, then how do we nirbhar on? What do we nirbhar on? So we have to see what commodities we have to do, what commodities are in demand. Like as a Singapore trader, we definitely do pulses, but I do oil seed, I do animal feed, I do grains. So that's the way I feel the way to go forward. So being India becoming Atmanirbhar for pulses, it can be a big change. So many countries are depending on India. It will take time, maybe another 5 years, 6 years, 7 years, but gradually India is moving towards that. So that can be a big shift in terms of dynamics for pulses community. Current crisis, shipping crisis, fuel crisis, freight changes, freight going up and down. So that is again a big change which we have to see how thing goes and whether it is stabilized, who will pay the cost. So these things are again a big challenge. And indirectly linked with energy is the same thing, insurance, packaging, fertilizer, everything which impacts trade, our price, our production cost of the farmers in a big way. So we have to wait and see how the prices react, whether the farmers are able to absorb the price, whether the consumers are able to absorb the price. So these are the major points which I can see, which you can see from the current dynamics which are changing.
Perfect, sir. No, actually, India's Atmanirbharta, sir, it depends on multiple factors, right? So I would say that overall, the percentage of domestic produce would increase, but overall, when it comes to volume, I don't think there would be too much of change. For a very simple reason is that by 2047, based on our estimation, India would require close to 45 million metric tons of pulses. Currently, we are at 31, 32. It goes up and down depending on the price point because pulses is very price sensitive for even the end user, the consumer. If at the right price the pulses are available, I think there is always a play for everyone. And India's Atmanirbharta will ensure that they are Atmanirbhar, but at the same time, rest of the world is also having some play in the game. And India is a large market, so I think government, when they say Atmanirbhar, they are not saying zero imports. What they are saying is that we should not be driven by the factors which are beyond our borders in our control to manage the availability and affordability. Now that brings me to our second very pertinent question, sir. You talked about the challenges and the stress which we are seeing. Now, based on that, these shifting macroeconomics indicators and currency fluctuation across emerging market, how do you think it is going to be for a trader, a seasoned trader like you, impacting your decisions, right? From risk management to day-to-day trade, and then the anxiety associated with what Mr. Trump tweets every day.
Yeah, means for us, every day again is a new day where Mr. Trump will come out with some sort of a decision, but gradually you get prepared with it. So For us, currently the main thing which is affecting our trade is the currency fluctuation. So our main buyers are India subcontinent, which are totally dependent on exchange. Today, buyer, when they buy, they don't know what exchange to calculate, whether they take 95 or they take 100. If they take 100, they cannot buy cargo. If they hedge, they cannot buy cargo. So they want to mitigate the risk, but they still cannot. But for us, in one sense, we are in a better position because we buy in dollars, we sell in dollars. So for our side, the current risk fluctuation is not there, but end of the day, it impacts our trade. We are not able to sell much because of the currency fluctuation, because of the freight hike, overall cost up, so markets are slow. Like you must have realized in last few months, I've never seen such a year in my career of like last so many years, like 4, 5, 6 months. There are some shipments going to India, but the sales are not there. Most of the traders, when you talk to them, most of the buyers whom I trade, I talk to them, they're saying we are getting cheaper locally, so why to import? So there are enough supplies, but yeah, the risk wise, that is the biggest part in terms of foreign exchange. One has to be very, very clear on that. Counterparty risk is again a big challenge. Counterparty risk, you have to be very careful. You have to pick and choose with your experience. If any counterparty can be good, which can turn to be a bad if they're sitting on over position, like what happened 2 years back. There were good counterparties, but their position went wrong. They went overboard, and end of the day, they lost money. So the question comes is, do you set up a risk limit for your buyers and sellers? This is again what I learned from my MNCs, which I worked for, corporates which I worked for. Set up a limit for buyers and sellers, see how much risk you can take, do what you can do, don't go overboard. So there has to be some risk limit for you, for your buyers and sellers, so that if something goes wrong, you are able to manage. Trade in commodity, not in exchange. This is my thumb rule when I do a trade. I have seen in my career in Adani, we used to make money on commodities. End of the day, PNL used to come out of India. They used to say we are losing because they used to cover exchange only after selling cargo, not on the procurement. But the market were not going up if the exchange was getting weak. Pulses is one commodity, unlike oil, the price do not adjust as per the exchange. Edible oil price adjust if exchange drops, price will go up. Pulses no. So if somebody is taking two exposure, I have seen so many companies. Typical example, Phoenix, such a big giant, turned up because of exchange, overexposure on exchange. So my suggestion to people is when you trade in a different country where you are exposed to exchange, don't take exposure, hedge it. If you're able to do it. If you're not able to do, don't play on exchange. Either play on commodity or on exchange. If you do both, you can get stuck up somewhere and you'll not make money.
Perfect.
Third point,
Perfect. Yeah, please
fourth point,
continue.
which I would say is have a clear transport freight cost. You should have a proper freight cost, freight contracts in hand when you are selling forward. If you don't have freight contracts, again, like as Mr. Sham also said, you make margin very thin. And freight surcharge, like this time, what surcharge, it came $2,000 per container. You're talking about $80 a container, which can be like 10% or 15% of your cost. Everything gone, you're losing money. So even try to take freight coverage if you're selling forward. If you're not getting enough freight coverage, don't sell in CFR terms, sell FOB if you're doing locally. If you're doing CFR, try to take a freight coverage, otherwise not sell. Pulses is one commodity I somehow feel it's not for MNCs. As a MNC, you want to do a big book. If you want to do a big book, you have to have hedging mechanism. Pulses, we don't have a hedging mechanism. I know tomorrow market is falling down in pulses, anything. I'm sitting on a 100,000 ton position. I want to sell, I cannot sell. If I sell to a counterparty who is weak, he will buy, but he will not pay me. So this commodity one has to do in a less volume. When I say not for MNC, that I'm not saying that they should not do, they should do, but it has to be properly hedged and managed in a way that they have a position properly covered in market fluctuation, which can be anywhere. Yeah.
Perfect. So Sunilji, last question before I let you go. From your vantage point, which supply and demand trends do you see heavily will be impacting the pulses trade over next, I would say 6 months? Which origins you think can come out as I would say Trump card, right? Not the real Trump card for the pulses trade.
Supply and demand impact. I've seen a big change in mung beans, which has moved in a big way from Myanmar to India. India has become a big exporter of mung bean. I used to not buy anything from India. Nowadays, I'm buying from India, mung bean selling to China. So that has been a big shift in supply and demand. Desi chickpeas, the way numbers are spoken by Jay and Simon, looks quite decent. Indian overall demand looks good. Black Mape to me currently looks a bit undicey because Brazil crop sold 200,000 tons, unsold maybe 150,000 tons. It's a big quantity and there are a lot of reseller in the market. But still, there is a shortage of black mape in India, what I feel, and there will be a demand, and they've been not buying the volume what they need. So overall, I feel there will be a decent requirement for black mape demand in India. Pigeon peas, yes, it's a lot of supply and a lot of stocks with government. And recently we heard government also want to sell cargo, their stocks locally. So we don't see really price changing big. But yeah, there have been shift which has been coming in terms of lentils from exotic origins like Kazakhstan and other places. So one has to be careful when they take positions on uh, from origins, matured origins like Canada, Australia, and the other origins which come on spot can really change the dynamics. So there'll be a good shift in origins and commodities. Like Brazil will be coming in a big way from instead of Myanmar. Africa in a big way in terms of Myanmar for pigeon peas, and Kazakh and other origin, CIS origin for lentils. There's always competitive. So I'm seeing this as a good shift in green mung from India instead of Myanmar to China. So these are a big shifts and good demand supply from these origins. As long as my last question, my last answer and suggestion is anything which India and China is buying, that commodity will move. They are a big economy, big consumer, and directly, indirectly, in terms of starch, in terms of noodles, in terms of pea protein, anything. China is coming up in a big way in terms of plant-based. So anything which India and China is buying, just keep watching and be in that market, and you'll be able to trade. Yeah,
Perfect.
that's all.
Thanks a lot, Sunilji, and I totally agree with you. Black market can be the black sheep, and in the pack of cards of pulses. Thanks a lot. And with that, we would like to move to our next speaker, and we are having in-house one of a legend, Mr. Dilip Mohanty. He is a retail sourcing executive serving as executive vice president and head of sourcing for agri commodities as Reliance Retail. He directs the procurement operations for India's largest retail supply chain, managing a massive portfolio of pulses, staples, dry food, to name few. His core expertise lies in designing farmer direct procurement frameworks, driving macro supply chain efficiencies, and spearheading the organized retail sourcing policies that ensures consistent quality as well as price stability for millions of consumers. Welcome, Dilipji. It's pleasure to have you, sir.
Thank you. Thank you so much for the nice words, Deepakji. Really appreciate.
Sir, actually, I'm having paucity of time. Otherwise, I can take at least half an hour just to describe your work. We have been doing such a great service to the nation by ensuring that, the consumer don't pay for speculation being done in the trade. So with that, I would come to the first question, sir. How do you see Indian pulses balance sheet, and which pulses can be a bother for upcoming season in case there is any bother?
If you look at the balance sheet overall, structurally, it looks slightly tight. If you look at the production and supply at this point of time, production is about 25 million tons. Consumption requirement is slowly inching up every year. It's about 30 million tons. We are short about 5 million tons. It is getting imported. The primary imports are tuar, urad, and mashur. And as far as commodities where you can have a botheration this year, first is tuar. Secondly, to some extent, I look at chana. If you look at the tuar this year, the production as compared to last year has reduced a bit from 3.6 million tons, it's come to 3.4 million tons, out of which about 0.8 million, 8 lakh tons is holding by government. So that is out of the market, out of this investment locked at the moment. We are completely dependent on the imports now, about 1.2 million tons from Africa and Burma put together. There could be weather risk, there could be logistical challenges or government policy changes, what we have seen 2 years back from Africa. Considering all that, anytime anything could happen as far as just getting into the peak buying or consumption of this thing. Plus, whatever import comes, the freight component has gone up, rupees depreciated, the replacement cost has gone up quite a lot. So, plus we are just heading into suboptimal monsoon. That is what we look at, about 90% long-term average. Considering all that, the world looks to be slightly tricky and difficult as far as India's consumption is concerned. If I look at the last 1 month, 1.5 months, the prices have already gone up by 5 rupees. Once the monsoon sets in, the consumption goes up. So we have to see the demand and supply, government's action. But two is very tricky at the moment. It looks like there will be shortage after some time. As far as Chennai is concerned, no doubt we have a huge crop, good crop as compared to last year. But government has taken out 2.2 million tons of crop, 8 to 10%. So that has moved up the prices by about 4 to 5 rupees in last 1.5 months. Then the next crop, if you look at the yellow peas, last year at this point of time, we were holding around 1.2 million tons of white peas. There's a major substitute for China. Now it's only 3 lakh tons. So there's a pressure on China from that point of view. Plus Australia, everybody is saying the crop will be 50%, how much it is going to come. No doubt last week we had in New South Wales and Queensland, there's a good monsoon. But considering all that, all put together, these two crops are looking very, very tricky. So, and all depends what kind of monsoon you get. Monsoon should hit any point of time. I think it started hitting Kerala today, it's hitting today. So monsoon, then what the government policies and government procurement as well as release plans, all put together, we'll see how the things pan out from here onwards.
Perfect. No, sir, I totally agree with you that we are having a little bit of tricky because of as you rightly said, 25 million tons of production and nearly 30 million tons of consumption. And offtake has been a little bit low because of the prices of vegetables and the fruits were pretty low because we were not able to export much to Middle East. So even that played a role in low demand. But as we see the setup of the monsoon, prices of vegetables and foods going up, you will find the demand getting generated. Now, coming to a very important question about farmer outreach, because see, when the government is buying so aggressively for a largest retail house buying, also trying to buy from the farmers become a little bit of a challenge. How you are able to solve this challenge? Because when the government, they have a huge war chest. And as you rightly also mentioned that they have locked up a huge amount of at least tuar with them. So in this scenario, how difficult it is to source from the farmer, sir?
It's very hard than it appears. All of us, we know every time we talk, their land holding is very small. As far as big retail outfit is concerned, what we look for consistent quality and predictable volumes. As far as you go to the farmers, their land holding is small. The surplus is also very small. So when the small quantities you buy from hundreds of farmers, your aggregation cost becomes high. The quality is slightly inconsistent. So logistical inefficiency you have. And farmers, they look for instant cash. Plus, they want you to be slightly flexible in terms of quality acceptance, which is very, very difficult from a big corporate like ours. Considering all that, farmers we look at all the avenues that we can, because our quantities are quite large. So we buy from multi-state, multi-mandis. We buy from in the daytime, we buy from the mandis. After that, from FPOs, then farmers, then millers, then we do our own imports. We have a combination of everything, and whatever comes from farmers are refused as an add-ons. So it's not the quantities that come from them, it's very little, not very on the higher side. Quite a lot of FPOs are giving us nowadays, but that's a slightly lesser quantity. Yeah.
Perfect, sir. No, I understand. These are a challenge. Still, we are struggling with this challenge to solve it, because unless we solve the basic framework of how we procure from the farmers, I think the right value unlocking for the farmers is difficult to happen. And sir, coming to the last very important pertinent question, how does the organized retail sourcing act as a stabilizer for both producer margins and consumer price inflation during the period of pulses deficit? We have seen Reliance has played a very important role in ensuring that making the processed dal available to the consumer. How important it is, right? Because, and at the same time also, like, you also get a lot of unnecessary, I would say, criticism sometimes when people start talking about, like, the retail prices are so high without understanding the calculation that actually processing of dal, right, is a cost, right? Transporting of dal is a cost, converting that into smaller package is a cost. So in your view, how the large retail chain like yours, they are buffering consumers, right, from unnecessary speculations, sir?
I think pulses normally they're monograms. They have grown once in a year, except for something like monk, and it's produced at 1 year, and somebody has to buy and hold it. And as far as organized retail is concerned, our volumes are huge. We have to have supply security. We want the material always on the shelf. So we buy much bigger quantity in many states, and we have got assured offtake. Considering all that, when during harvesting time we buy bigger quantity that spreads over a longer period of time, the farmers are not completely dependent on RTRs, or this to that extent speculation reduces. So buying spreads over a period of time, we give a better price. There's better visibility when we buy a lot of quantities that enters the farmer channel. It's their visibility, it's audible, and speculation to that extent reduces, and we keep the material on our custody. But as a big corporate, how we see, suppose today the price of chana is 60 rupees. The season started 54 rupees. We work on supply chain efficiency, procurement efficiency. Can you buy with one, hold it for the rest of the month, rest of the requirement of the rest of the period, which is 3 to 4 rupees cheaper than the replacement cost. We work on the supply chain efficiency, buy on the origins, the direct to distributions without any middleman in between, because each hand that comes in between, that adds to a cost. We work on the better processing efficiency, all that, plus branding and valuation. These are the things we work continuously. And a big corporate, we look at bigger volumes. We don't want a big margin percentage, but we want a thin margin with bigger scale. So that is how we look at the moment.
Perfect, sir. So thanks a lot. It was pleasure to have you, sir. Actually, Dilip, you have been someone who has been ensuring that this trade become disciplined, and our consumers, they are not taken for a ride. And it is always a pleasure. And please continue the great work
Just
you're doing.
add one more thing.
Please,
Lot of
please.
disruptions keep coming in a big corporate. How we handle that is also equally important. Suppose sometime back we had some COVID disruptions. Now we see Hormuz disruptions. So immediately when our quantity, I think more than 100 items we buy, quantities were quite large. Suppose I'll take the Hormuz disruption happen. What we do immediately? First thing we see what is coming from that region. It is dates is one of the items. Saffrons comes there. Mamra badam comes from there. So immediately we try to stock it for 2 to 3 months. Then other input items, edible oil as well as all dry fruits. That we want to secure it for next 2 to 3 months. Then we see what are the exportable items. That are the whole spices goes out of India, basmati goes out of India, then Kabuli chana goes out of India. Once this kind of disruption, that the sales goes down and price goes down. So we reduce the quantities for that. If you look at the local item, when you suppose sugar we want to buy, so there is a challenge at the moment. In the case of sugar, there's a fuel shortage, there's a labor shortage. So we are getting the metal, keeping low to our warehouses. We are making long-term contract with the millers. We are giving advance payment if required. So we want to have the supply security. Second thing comes at the cost. That is how we have been doing. So it's quite fun, I think, doing all this. So every time you get a different challenge, and you have to handle it to the best extent possible.
No, that's a great insight, sir. And a lot of people think that working for a large corporate is you sit in your AC cabin, you are having 10, 15 people reporting to you in the morning. You say, okay, today I need to make so much of money. Go and make it for me. It's not easy. People need to understand that. So thanks a lot for the insight, and a pleasure to have you, Dilip Montiji. It's always like, I'm very happy, and I'm glad that you have always been very kind and supporting our initiative. Thank you, sir.
Thank you so much.
Yeah. So now we go to our next speaker, and we are having in-house Mr. Binod Agrawal. Mr. Agrawal is a veteran agriculture leader currently serving as a managing partner at SGR Agri Steel LLP and Countryman Grains. With decades of hands-on experience across Indian commodity trade, his professional leadership focuses on modernizing trade and building transparent long-term partnerships across international agriculture value chain. He is an authority when it comes to the trade, agri-commodity trade between India and Bangladesh for sure, and many other regions. Welcome, Binod Bhai. It's pleasure to have you, sir.
Thank you. Thank you, Deepak Bhai.
So, sir, first question, how do you see the current structural shift in global pulses trade dynamics in general and in India? and with respect to the trade with Bangladesh and Middle East, sir?
Deepak bhai, like over the past few years, our pulses trade is mainly driven with the policy. Earlier, we used to see the crop size, production, demand, but today changes in duty, phytosanitary rules, currency movement, and government interventions that change the market dynamics overnight. India become the largest pulses consumer in the world, and any policy change in India impact global trade. Same is with the Bangladesh. Bangladesh is not generally changing the policy, but the political scenario there is, as of now, still not good. So the growing consumption and dependency on import totally depend upon the political as well as the policy shift in the market. As a trader, we have to remain flexible. Like any change in the policy that impact the market overnight. Now, as a trader or as a broker, I have to have a plan B, plan C, plan D. If there is any change, any shift in Indian policy or say any country's policy, and the dynamics changes in that country and that becomes unviable, so immediately I have to shift that cargo with the help of my shipper to some other country. Now, when the duty changes, anything changes in India, the other country become the opportunist buyer. But we have to do a calculation, like if bringing it to India, how much they are losing, and if shifting it to other country, how much they are losing. If the loss proportionate is less in other country, obviously it will shift to other country. So we have to see the policy changes very frequently, and we have to follow that instead of following the crop numbers and the demands. Obviously, this used to be the primary factor, but now it is a secondary factor for us.
Perfect. But sir, Vinod bhai, don't you think that sometime the market, because of there has been so much talk about policy, right? Sometime rightly, sometime wrongly, like, which also create anxiety and unnecessary movement, right? Or the perception of the movement. Because if you see the past at least 9 months, the government policy has been pretty stable, right? Except a small change in the case of yellow peas. Right, the government of late, like, if you see last 16, 17 months, they have not changed any policy. Tuar, urad, no change in the policy. Chana, they reduced the duty, and after that, actually, it is pretty consistent, and just small 10% increase in the lentil duty and 20% increase in yellow peas. In the March also, there was so much of, since January, speculation that government will put this, that, blah, 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 right? Market was going up and down. If you can recall, during the Gulf food time, right? The market just move on assumptions that the government policies are going to change. Somebody says that I was in the ministry, मेरे को बता दिया है कि इसके ऊपर तो सरकार duty हटा देगा, and suddenly market react. And I was saying from the day one, from 1st of January, there is going to be no change in pulses policy on 31st of March. And actually, government has given those signals very brightly to everyone. Even if you see that recently there was the panic was being tried to create in one interview, the secretary said very simply that we have buffers, right? We don't see there is a possibility of intervention today because the price is not actually going haywire. A little bit increase post harvest, post sell to the government in the period of MSP does happen. The news was that सरकार अपना बफर नहीं बेचेगी, right? There is no change in policy. गवर्नमेंट ने सिर्फ इतना सा स्टेटमेंट दिया, राइट? अभी हमको रिक्वायरमेंट नहीं लगती है, रिक्वायरमेंट लगेगी तो बेचेंगे. दैट डजंट से कि अगर कल अगर आपने 20%, इफ यू हैव स्पाइक्ड अप तुअर प्राइस और उड़द प्राइस विद 20% tomorrow, government will not sell. Government will sell. So government is, see, again, we have to understand the policy is made, right? But in the pulses trade, unfortunately, it's not happening too much in other commodities, that there is so much speculation about assumption, what government can be doing, what government will be doing. So if you see, I'm talking about with these factual numbers, government policy actually has changed minimum when it comes to pulses in past 18 months. You see wheat, you see sugar, you see edible oil, the policy changes are more than in the pulses. Pulses, there was small tweaking. Over to you, Vinod, for your comments on this.
You see, there are speculators in the market. Sometimes they like the policy change, sometimes they don't like the policy change. When the government intervention is nullified, then the speculator try to spread the rumors that tomorrow duty going to be changed, tomorrow going to be this, tomorrow going to be that. But now our government is smart enough now. Earlier, they used to listen to limited handful of people, and those handful people were misguiding the government that this is the stock, that is the stock, this will happen, that will happen, and that has ruined our government policy in past. But since last 1 year, or say we can say 2 years, the government becomes so smart, they are listening to the people, but they have their own mechanism, they have their own people, and they are doing their international uh, dynamics and the data collection, and they know that the demand supply is enough in the market. There's not going to be any inflation in pulses. Yes, there are some factors, rain, logistic issue, the market goes up, but the people have burned their finger so large. Any small spike in the market, say 50 paisa or 25 paisa a kg, they want to square off their stock, because they know if I don't sell my stock at increased price of 50 paisa tomorrow, someone will come and sell. So in that run, I think that things is controlling the market, and this don't need the government intervention. The wheat trader, the stockist, they themselves are killing the market, not the government, not the any international dynamics.
I totally agree, Vinod bhai. Thanks for very important intervention, because yes, डर के आगे जीत है, like रोज मत डरिए, right, sir? Government policies are pretty stable, and in fact, if you ask me, until and unless there is huge spikes, government policy is gonna be remaining stable, and not much of movement there from the government side. No excitement or no TRP news from the government side. Now that brings me to another an important question. The South Asian trade cycles, right? They depend on the currencies as well. And we have seen that huge fluctuation in the currencies of some of the countries you deal with. How do you take care of the currency challenges? And hedging has also become pretty costly of late. Are there sufficient margin in Pulse's business to actually take cost of hedging and also do the business?
Very frankly, Deepak bhai, I being the indentor, I sometimes, not sometimes, I'm always surprised why the importers are importing pulses. Because I know the what rate they are importing, the exchange they are giving, and what they're getting into the market. To me, the importers are doing charity. Government should have a program end of the year, and they should reward the importers, because I have not seen any importers making money by importing pulses. Yes, their hands are tied to manage their bank. They have to import whatever with the pricing, whatever the costing it is. They are importing it as long as banks are not hammering it. And you can see the list of importers now. Hardly you will find 10 good importers in the market, and their situation I can understand, and they themselves can understand, and their bank can understand. So I don't find pulses import lucrative. But yes, as a broker, I would like them to import more and more, but cautiously.
Perfect. No, thanks a lot, Vinod, for this. See, that is what the beauty actually. You make things so simplified and also factual. That is a great quality you are having, and I believe that more and more people import, more and more people do business with you. And definitely, we would make a request to government that actually any importer who loses the maximum amount of money, he has done service to the nation, and he should be given a reward for being a social enterprise, not just an enterprise. Thank you, Vinod. Pleasure to have you, sir.
Thank you. Thank you. Thank you.
So now we move from India to our next door neighbors. We are having Mr. Taya Balgamwala. He is a prominent commodity executive serving as a director at HnyB Group, a leading name in Pakistan's agri-commodity and pulses trade. A central figure in regional trade advocacy, his expertise focuses on managing cross-border trade flows and building resilient supply channels for international pulses market. Welcome, Tayyab Bhai. It's a pleasure to have you, sir.
Thank you, Deepak bhai. How are you?
All good, sir. All good, sir. God has been kind. So, sir, first question to you. How do you see the Pakistan's balance sheet, especially, sir, for chickpeas?
Pakistan, chickpeas. I was also on the panel in GPC Orlando recently, and our contention is that Pakistan needs at least 150,000 to 200,000 tons more of chickpeas till November, till the new crop Australia. And we are foreseeing that Tanzania will probably go mostly to India due to the duty advantage. We have had two vessels booked from Australia. One is coming on 15th of June. The other is expected to come in the first week of July. That is around 50,000 tons. But we still feel that we will need 150,000 tons of more chickpeas into Pakistan because our local crop is maximum 350,000 tons and our consumption is around 700,000 tons. So given the carry forward as well as whatever was already imported in containers and bulk vessels, we feel this is a safe number to 150,000 tons. Maximum side 200,000 tons.
Excellent. Sir, how do you are taking care of the currency? Because we are seeing that Pakistan is in a good shape. Actually, your currency has improved, but at the same time, that creates a little of the challenge for the importers. How is currency looking like to you? Do you see that is created a little bit of a challenge for our importers?
Currency for the last 6 months, in Pakistan has been very stable. Our government has taken steps just to ensure that, what the importers or the exporters were demanding from the government for a long time was that we need stability. So, right now, over the last 6 months, it has hovered between 279 to 281 maximum. And of late, it has come down to 278, 278.50 even, which is beneficial for importers. But we don't see a sharp increase in currency unless, of course, this war drags out and crude prices go through the roof, which they were, but fortunately they've come down. And but if that is something that we are foreseeing, we also feel most of the businessmen feel that there is some sort of artificial, stability in the currency, and eventually the currency will have to devalue because right now they are financing it from the reserves. We are getting a lot of uh, aids or whatever you can say, IMF tranches. But eventually, we will have to put it on a floating mechanism because it is not beneficial. It is affecting our reserves. It is going to lead to inflation. So we feel that, yes, over the next 3 months, we don't see a major devaluation. But post that, there is a possibility, which also many of the analysts have predicted.
And Deepak, your views on the challenges, the crisis which we are seeing of late in Western Asia, how the logistic and insurance and all these things are impacting the Pakistani importers and exporters both, because you do also a lot of exports. So how do you see that this is playing out? And also dovetail in the same question, actually, you also deal a lot with Middle East. How do you see that actually like in a business with Middle East getting impacted?
It's a very interesting question because, Middle East has been Pakistan's big market for corn exports, for basic products like, we do steel over here in Pakistan, so scrap is coming from there. A lot of FMCG products are coming from there, back and forth, also exports. So just to give you an idea, Dubai freight from Pakistan for export used to be $100. And I asked 3 days back, it was $2,000 per container. So you can see the huge increase in that. So it has hampered a lot of trade. Also, more importantly, for pulses or for other products, Dubai was the transit hub. So a lot of containers got stuck over there. Desi chickpeas, lentils, all that, and many of the importers had to settle in Dubai only and sell it out to Dubai importers. And that sort of created this artificial shortage over here in Pakistan. And that is one of the reasons why importers rushed to get two bulk vessels of desi chickpeas, because the containers which were booked were not coming in. And even if they were coming in, they were coming in from other transit ports. And there were a lot of delays in reaching. Usually from Australia, let's say a container comes in 35 to 40 days. We have cases where containers have not reached for 100 days, 120 days. So it is also damaging the quality of the product. And this is not just Australia, I mean, it's from world over. Secondly, we are also facing in Pakistan of late, because of this war, there have been some sanctions from UK also on Russia, which were not there previously. And we are facing issues in payment of Russian products in Pakistan. Earlier, there used to be no problem. 8 or 10 banks used to pay. Now there are only 2 banks left which are paying. So a lot of cargo is stuck at the port locally. They are having to switch documents to other banks. Then some banks are asking to pay in yuan, some are saying to pay in dirhams. So, I mean, this war has had a lot of challenges indirectly or directly. Some are apparent, some are, behind the scenes. But yes, logistically, there have been a lot of challenges. But fortunately for Pakistan, other products like, let's say, oil seeds coming from Brazil, from Canada, these kind of products, they're all in bulk vessels. And that has not been much hampered, only 2-3 days delay. Palm oil, which is a big import, is also okay from Malaysia. Wheat, fortunately, we have a crop going on. Sugar, we are self-sufficient. So rice, we are self-sufficient. So at the moment, I think logistically, pulses is badly hampered mostly. And other non-agri products like steel and these, which depended on Middle East. And some of our exports, of course, are also badly hampered because of it.
Tebbai, in case you want to answer this question, then only answer it. But I'll have liberty of asking it. We are also having a lot of information inside that the land border trade with Iran has increased, and that
Yeah.
is leading to good business for Pakistan. Is that really happening, that you are able to send material to Iran through land borders? Specifically, I'm just talking about agriculture commodity, which is on a humanitarian ground, nothing else, sir.
Not really on just on humanitarian grounds. Actually, there was a notification issued by the Pakistan government, which is applicable till I think a certain date in June, and it was they allowed. They of course used the humanitarian excuse, but around 8 or 10 products are allowed by road, which is officially allowed now. And in that case, they have allowed that you can take money even in rupees. You can take money out of Pakistan. You don't need to go through the normal banking channels, and you can go through road through the borders. There is no financial instrument requirement, which used to be there for other products, which is still there. So in that case, many of the rice exporters are getting cash payment to the factory, and importers over there are lifting X milk. But officially, around 8 to 10 products, medicines, and basic necessities have been allowed. Sugar, wheat, these kind of products have not been allowed. But rice is one of the staple items. Pulses, unfortunately, has still not been allowed over there. But this is going to finish. In addition to this, the government of Pakistan, unfortunately, which is quite tragic, the transit trade is banned. Indian products used to come, other products used to come, but Afghan border is shut. So they issued a notification for transit trade for Iran. So through Gwadar port, through other ports, transit into Iran is allowed now. But since it is a new concept, there are no transporters available. There is no modalities as such done. So it's only in paper so far. But yes, these things are happening and some trade is happening. But from mid-June onwards, if the government does not issue a new notification, then I think only the unofficial channel might work. But then naturally the volumes will be curtailed into Iran from Pakistan.
Perfect. Tebbai, no, my focus was rice only, and as you have mentioned it,
Yes.
right, rice. Iran is a big consumer of Indian rice as well, and unfortunately, we are
Yes.
not able to supply. And I think
Yes.
India's lost, Pakistan gained. But anyway, people in Iran, if they are getting rice, I think it is much welcome. Thanks a lot,
Yes.
Tayyab bhai. It was a
Thank
pleasure
you. Really
to
appreciate for always inviting. Thank you, Deepak bhai. A great event, and it's been a pleasure always speaking with you. Thank you very much.
Perfect. So with that, we
Thanks.
come to end of our first session on pulses, covering Asia and Pacific region. We had speaker all the way from Australia, Myanmar, Singapore, India, Pakistan. So overall, we have completely covered the South and Southeast Asia. Next session start at 9 a.m. GMT or 2:30 p.m. India time, where we will get into a little bit aspects about Middle East, Europe, and Africa. As you know that this is our 5th day, and we have been pretty happy and thankful to all our esteemed speakers, our esteemed audience, and our esteemed partners for helping us make this Marathon Commodity Week World 2026 so far a great success. We have 5 more sessions to go. This was 13th, as you know, and looking forward to have more engagement going forward.